Imagine a future where regular investors can beat the big banks and hedge funds, and where your average Joe can beat the so-called specialists at stock picking. Sounds like a dream, right? Well, not if you have read One Up on Wall Street. So, let us begin. Do you think that investing isn't for you? Or do you think that the losses you sustained in your earlier attempts were just a tad too much? Well, if your answer is yes to any of these things, then my friends, you have come to the right place. Today we are going to talk about a book that has changed the investment game forever. This book by Peter Lynch, a great investor, has become a classic because it teaches regular people how to succeed in the stock market. Whether you're a seasoned pro or just getting your feet wet, this video will provide you with the tools you need to make smart investment decisions that could improve your financial future. Lynch maintains that everyday individuals, as consumers, have an untapped edge over Wall Street experts. By observing and reflecting on the products and services they regularly engage with, retail investors can spot opportunities that institutional investors might overlook. Lynch's mantra advocates for the everyday investor to harness their unique understanding of what's trending, which products stand out in terms of quality, or which services they and their peers frequently use. This grassroots perspective could offer valuable context to assess potential investments. Imagine this. You have a local coffee shop that you love. Each time you visit, there's a seemingly endless line of customers waiting. Observing this, you decide to delve into the company's financial health, future growth projections, and market competition. Could this popular coffee shop be a worthwhile investment? By investing in a company whose vision resonates with you, not only do you become more invested in its success, but you can also leverage your personal insight to gauge its potential. Lynch's advice isn't just applicable to the retail sector. It could relate to your area of study, professional field, or even a hobby you're passionate about. By investing in what you know, you can use your knowledge to better understand the company's position in the market and its potential for success. Okay, so now understand the types of companies, so we can decide which company is better for our investment. There are 6 types of companies. Let's understand them one by one. Number 1. Fast growers. Companies considered fast growers are those who have a track record of increasing their earnings per share by at least 25% annually on average. The trick to investing in such a business is to be watchful and to get out before the growth rate slows down. Stocks that are not widely held by institutions are infrequently discussed, and do not have much analyst coverage is ideal for rapidly expanding companies. Companies like these are often overlooked. Well, one such company is Tesla, and we have all seen the potential it has. After all, it is the company that made Musk his billions. Amazon is also a good example of such a company. Number 2. Slow growers. A slow grower is the antithesis of a quick grower. Companies with slow growth tend to be profitable. Companies with dividends that increase reliably year over year are the best dividend payers. The payout ratio reveals the proportion of a dividend-paying company's earnings that are distributed to shareholders. In my perspective, anything beyond 100% is a red flag because it cannot be maintained indefinitely, while anything below 60% is prudent and more long-term. This is the perfect example of Coca-Cola. The company has steadily grown over the last few years, but you will have to wait to reap the big rewards. Duke Energy is another company that fits the bill perfectly. Number 3. Stalwarts. Stalwarts fall in between fast and slow developing plants. They've slowed down considerably, neither becoming a quick nor a slow grower. Peter Lynch has stated that these businesses are resilient to economic downturns. That includes businesses like Unilever and P&G that may sell basics. Number 4. Cyclical. Companies having cyclical earnings patterns are often referred to as cyclical. Since oil prices fluctuate with supply and demand, businesses involved in the oil industry could be at risk. The price of memory is another commodity whose value tends to rise and fall in cycles. The key to profiting from cyclical businesses is to enter during the downturn and sell during the upswing. ExxonMobil and Ford Motor Company are 2 companies that come to mind when you hear the word cyclical company. Number 5. Turnarounds. If a company is in a terrible spot but has the potential to improve its situation, it may be a good investment candidate for a turnaround. If there is any hope for a turnaround to occur, the company's balance sheet must be strong enough to carry it through the difficult times. Examples of this include Apple and Best Buy. Both struggled during certain phases, but are now going stronger than ever. Number 6. Asset plays. Peter Lynch advises investors to seek a company's underrated assets. Assets may be either physical or conceptual. It's crucial to analyze the firm's balance sheet to see if it's taking on too much debt, which could reduce the value of its assets in the long run. Back in the day, Disney may have been seen as an asset play because Marvel wasn't being fully monetized, despite the fact that they owned it. Alphabet, Google's parent company, is another example of such a company. Now let's understand the importance of do your homework. Peter Lynch stresses the need of conducting one's due diligence before making any financial decisions, as information is power in the world of investing. He recommends that potential backers do their homework on a company's finances, advantages in the market, and future growth prospects. To see how this careful investigation might lead to wise financial decisions, read on. Knowing how the numbers add up is essential for gauging a company's financial health and making investment decisions. Financial statement analysis is emphasized by Peter Lynch. This includes the balance sheet, income statement, and cash flow statement. Investors can learn about a company's assets, liabilities, and equity by looking at its balance sheet. This can be used as a barometer for the company's solvency and capacity to meet its long-term commitments. The income statement details the revenues, expenditures, and profitability of a business. Investors can determine the company's profitability by analyzing its revenue growth, gross margins, and operational expenses. The cash flow statement, which records the company's financial inflows and outflows, is similarly crucial. The ability to pay dividends or decrease debt, as well as support operations and engage in growth possibilities, are all factors that can be inferred from a company's cash flow. Investors can learn a lot about a company's financial health, profitability, and risks by looking over its financial statements. With this information in hand, they can confidently decide whether or not to put their money into a certain stock. People spend months saving up for a house but only minutes researching and buying stocks, which is why his remark that it's no accident that people who are geniuses in their houses are idiots in their stocks is so amusing. And with the incredible strength of leverage, homes are skewed heavily toward the owner. The PEG ratio. Peter Lynch teaches his clients how to use the price-earnings-to-growth (PEG) ratio, an important metric that complements an understanding of financial statements. The PEG ratio evaluates a company's market value by comparing its current price to its future earnings potential. It's possible that the PE ratio isn't sufficient on its own to paint a clear picture of a stock's value. However, the PEG ratio assists investors in identifying inexpensive stocks that have the potential for considerable growth by considering the company's predicted growth rate. If the stock has a PEG ratio below 1, it may be underpriced since its growth prospects are better than its present market price. However, if the PEG ratio is larger than 1, the stock may be overpriced. Investors can find promising investment possibilities that fit their growth forecasts and stock pricing criteria by using the PEG ratio. This allows them to make better-informed investments based on factors like expected growth and fair market value. Be patient. In the final chapter of One Up on Wall Street, Peter Lynch discusses the need for patience in the investment sector, which is often neglected. He stresses the need for patience and the self-control necessary for long-term investment success. Let's look at what you can learn about patience and how it might help you along your financial path. Lynch teaches his students that patience is one of their greatest assets in the world of investing. While the market can be volatile and unpredictable in the near term, savvy investors know to look for quality companies that will pay off in the long run. Investors can set themselves up for potentially large rewards over the long run if they practice patience and resist the urge to make rash decisions based on short-term market noise. This is demonstrated by Lynch's 3 to 5 year rule. He recommends a time horizon of 3 to 5 years for investors, giving businesses enough time to implement growth strategies and realize their full potential. This guideline serves as a helpful reminder that investing is a process with a lengthy time horizon and that positive results don't always appear right away. So that is all the time we had today, folks. Hope you enjoyed this video. Do not forget to subscribe to our channel and do hit the bell icon on your way out. See you all next time.